Welcome to the Tax Awareness Show. My name is Shillyboy Mothiba. I'm your host. Today, I want to speak in the main to entrepreneurs and particularly small and medium enterprises owners. The reason why I'm saying that today I want to have a chat with you, it's precisely that in my experience, I've noticed one thing, that entrepreneurs get so caught up with idea of doing business development, finding one client after the next. However, when it comes to the financial literacy side of things, when it comes to doing the tax planning and leveraging some of the tax incentives that are out there from the tax legislation, they typically don't actually take advantage of those tax incentives that National Treasury together with SARS have provided to those enterprises. Therefore, today I'm gonna, as usual, I've got my legislations, I've got my notes with me. I'm going to take you through one or two of those tax incentive schemes that I think that you need to bear in mind as an entrepreneur. So the first one I'm going to talk about is the deductions in respect of small business corporation. Right, you probably heard people talking about small business corporations, but I'm going to I always like quoting the legislation. So we're going to read the legislation together and we're going to simplify to you as the entrepreneur rather. Okay. What is this deduction in respect of a small business corporation? Okay, maybe let's start with defining what is a small business corporation so that you actually make sense if these actually incorporate, or rather it involves you. Okay, so it's defined as small business corporation means any closed corporation or cooperatives, for those who may be having cooperatives, those community cooperatives, or you've got friends that you're actually forming a cooperative, this will also include you. Any private company, as defined, those of us who registered company with CIPC, okay? Or a personal liability. Personal liability companies will typically be those companies that the likes of lawyers will have, doctors, or for that matter, even auditors. I know that they will typically have personal liability companies registered with CIPC. Okay. If at all times during the year of assessment, all the holders of shares in that company, cooperative, closed corporation, or personal liability company are natural persons. Okay. Now, what it means that very, very, very important that for you to qualify as a small business corporation, it means that the holders of the shares of those listed entities needs to be natural person. What is natural persons? It's you and I, the people in particular, person in particular. Okay. And then it further states that where a gross income for the year of assessment does not exceed an amount equal to 20 million. That is very, very important. I think that's one of the pre-requirements that I think that it actually may disqualify a lot of people, particularly including that one, that a natural person needs to be the holder of the shares. So meaning that your revenue, gross income, meaning that the sales and everything that is gross income as defined, typically it may be similar to revenue, must not exceed 20 million. So that is very, very important. So if you're one of those, you own the shares in your company directly, or a closed corporation for that matter, or personal liability company, and you also not making more than 20 million rand and within a year of assessment, meaning that the year that you are operating, starting until the end of your financial year. Therefore, it means that you potentially can qualify as a small business corporation. Now, let's assume then you qualify as a small business corporation. Now, what the act, or rather the section that speaks to that, okay, what the section that that speaks to the tax incentives that are provided by this section in the Income Tax Act, which is section 12E. Maybe let's look at the at the what does the section actually tells us. If you look at the subsection 1, it says where any plant or machinery, and then say obviously as referred here to as an asset owned by a taxpayer which qualify as a small business corporation or acquired by such a taxpayer as a purchaser, right, is brought into use for the first time by that taxpayer on or after the 1st of April 2001 for the purpose of that person's trade other than mining or farming. So you already see that this section does not actually speak to you if you are in farming. If you are in farming and or mining, then this section will not be speaking to you. Okay, so that is also very, very important. And then is used by that taxpayer directly in a process of manufacture or any other process which is of a similar nature carried on by that. So this section 1, it's actually speaking to section 12E subsection 1. It actually speaking to those that SMEs or small business corporations that are actually in manufacturing. So that is very important. Now, what is the deduction? A deduction equal to the total to the cost of such asset shall be allowed in the year that such asset is brought into use. That is very important. I mean, let's look at this way. Say, for example, you purchase a plant for your manufacturing business and you bought it for R1 million. It means that on that year of assessment that you brought that particular plant into the business, that R1 million will be deductible in that particular year of assessment. That's a lot. So meaning that you can actually potentially reduces your tax liability. And that's one of the incentives, by the way. And I think this is a very brilliant thing particularly for those who are in the manufacturing industry, as this section applies, subsection rather, it applies to those who are in the manufacturing sector. I think that is something that you as an entrepreneur or a small business corporation, you need to take advantage of that. Okay. The interesting part with section 12 capital E, right? It further make a provision, or rather there's a provision that actually allows those small business corporations having brought assets that are actually not being used in the process of manufacturing to also qualify, which means that these deductions, they are not only for those that are in the manufacturing sector. But what is that subsection? It's subsection 1 capital A. Okay, it says subject to subsection 1, where any machinery, plant or implement, or rather here referred to as assets, is acquired by small business corporation under an agreement formally and finally signed by every party to the agreement on or after 1st of April 2005, which means that is already applicable to us. The amount allowed to be deducted in respect of that asset must, at the election of the small business corporation and subject to the provision of that section, be either the amount allowable in terms of and subject to that section, or an amount equal to 50% of the cost of the assets in the year of assessment during which it was first brought into use, 30% in the first succeeding year, and 20% in the second succeeding year. So which means that what they are saying here, what they're saying is that if you brought those assets as machinery, plant, implement, utensil, article, aircraft, or ship, in respect of which a deduction is allowable under section 11E, right? So meaning that at your election, you can actually decide as to whether you want to use section 12E, subsection 1 capital A, or you want to elect to use section 11E. So that is for you to elect and opt which one it would be more beneficial to you as an entrepreneur. And this is very, very important, because you may find that you get much from cash flow planning point of view. It makes sense to follow under this as compared to section 11E. So that is very, very, and the nice thing is that the great thing about this is that it's actually not only talking to those, it talks to small business corporations irrespective of which sector you are in. So that is brilliant. The first one we spoke about in subsection 1, it spoke to those that brought assets in the manufacturing sector. So it's a special tax incentive for those that are in the manufacturing sector. But then this one, it speaks to any other small business corporations. They could be in IT, they could be in they could be in plumbing, they could be doing construction for that matter. So, and as long as they're not making they meet the definition of small business corporation, therefore that section 12 capital E subsection 1 capital A will be applicable to them, right? That is the first point. Then they can elect whether they want to use section 11E, or for that matter, they want to use section 12 capital E subsection 1 capital A. So that, you see, these are some of the incentives that can actually benefit you as an entrepreneur, and you can actually, for that matter, be doing a cash flow planning. I mean, if you are getting deductions for the plans or the assets that you bought for your business as early as possible, that can actually work wonders for you for cash flow planning point of view. I think that's one of the section. So if you've got questions around this and you want to know how you can leverage these tax incentives that National Treasury is actually make it available to stimulate the SME sector, and we need to start bringing awareness around some of these tax policies that National Treasury is actually making them available to enable and to strengthen and to actually stimulate the entrepreneurship around SME in the country. So if you've got questions, you're more than welcome to WhatsApp me on 074 589 6439, or you can email me at Shillyboy at the tax awareness .co.za, or Shillyboy at tax80.co.za. Okay, so that's about it. And let's also look at other tax incentives in another segment. Okay, so in this segment, continue with our tax incentives, I'm going to actually look at those that are investing in inner cities, right? So you could be one of those people that actually you're a property investor, or for that matter, you're a business that wants to operate from the inner city for whatever business, strategic business reasons that you might, reason why you want to operate from inner city. So since 2003, let me go into that section. That's section 13 quad. I've got my legislation with me here. I'm going to go directly, and we're going to read that section together so that you understand if you're a property investor, business person operating in that sector, or rather operating from inner city, you might want to look into this. Okay. So yes, I think this was brought in 2003. Why I'm also raising this is because in the recent 2025 national budget speech, Minister of Finance actually proposed that this section 13 quad actually be extended. Yes, be extended by another 5 years. And I think the logic behind that is that they're still consulting with respective municipalities to see if this provision or it's actually still beneficial for those municipalities. But equally so, the next 5 years, it provides you as the investor enough time to plan and have a certainty around the existence of these provisions. So when you're operating as a business person, you want certainty. But this is tax incentives. this is something that you can actually take advantage of as the investor. So maybe let's look at, so there are areas that are earmarked as, or they're demarcated by the municipalities as an urban development zone. So you can go to each municipality and just try to identify those areas so that you know which, if you are investing in a particular area, is it classified as urban development zone, so that you can qualify, because that's the starting point. You can't just invest any place. You may find that certain areas are not earmarked or demarcated as urban development zone. So your starting point should be to contact the website or a relevant town planning department of your respective municipality and see if your area of your interest is actually demarcated as urban development zone, so that you already can qualify for Section 13 quad. Okay, what does this section actually tells us? Maybe let's look at subsection 2 of that particular section. It says, there must be allowed to be deducted from the income of the taxpayer an allowance determined in terms of subsection 3 or subsection 3 capital A in respect of the cost of the erection, extension, addition, or improvement of any commercial or residential building or a part of a building which is owned by the taxpayer and is used solely for purpose of that taxpayer's trade. Now, let's unpack some of the key words here. Allowance needs to be determined in terms of section 3 or subsection 3A, capital A. We'll look at what those sections are saying. That's number 1. Number 2 is that the allowance needs to be as a result of the cost. So you need to know what it's made up of, a cost amount, right? That's very important. And then also you need to know what those costs are actually incurred doing what. So is erection, extension, addition, or improvement of any commercial or residential building. So, which means that even for those who are targeting inner city accommodation sector, you want to invest in that space, you will potentially find yourself qualifying for these urban development, potentially, because you still need to meet other. And for those who might want to have offices or retails within urban development, like those small shops, you buy a block of building and you want to convert it into a retail center in a demarcated area, which is urban development zone. So you could benefit from that. Others, they may want to go into student accommodation from inner cities or those areas that are earmarked or demarcated as urban development zone. That also can actually benefit you, right? You can actually benefit from that. Okay, so exactly that. They say if the building is situated within an urban development zone, so it's those are some of the pre-requirements that you can actually follow up and read at your own leisure. Okay, so let's assume then you meet those criteria. Now let's work out the tax incentive, because that's what it helps you from tax planning point of view. And the reason I'm bringing all these is to show you that within the tax policy system, there's what we call tax incentives, and these are made available to you as business person to actually benefit from them. But it's for broader purposes. The thinking behind this urban development zone, the history and the thinking behind was to ensure that the urban cities that they remove the deteriorating, or rather they remove the state of our inner cities or areas that are not actually pleasant, and as a result, the decay that we are seeing in our inner cities. So that is the thinking behind, so that we attract more investors in those areas. So that is the logic, and that is the thinking behind an introduction of these provisions, or rather these particular particular tax incentives. Okay, now let's look at subsection 3. This is where it's so important for you because you want to know how you're going to determine that allowance amount so that you are able to benefit from that. Okay, it says the amount of the allowance contemplated in subsection 2, which is exactly what earlier on when I spoke to that, it says, in the case of erection of any new building, let's say, for example, you go and you find distressed property and you demolish it and you want to build and this speaks to you. So you'll be allowed 20% of the cost in the first year and 8% in subsequent years. So which is quite significant. I mean, say for example, you spend about 5 million. So meaning that 20% of that, which is R1 million, will be allowed in the first year you actually brought that particular building into use in your trade. So that is a very important. So that deduction will be allowed in the year of assessment and in which that building is brought into use by that taxpayer solely for the purposes of that person trade. So you can't have situation where the building is not used for not other than for the purpose of trade, and then you will not be eligible to 100% of that particular building must be used for your purpose as a taxpayer for the purpose of your trade, and that's very fundamentally important. Okay, so but 20% and 8% subsequent. So that's for any erection of any new building. Let's say then you find building and you're not actually demolishing it and you're not starting from the scratch, or for that matter you found an empty land in the inner cities or in an area that is demarcated as urban development zone, and for that, let's say now in this case you found an existing building that is distressed, you instead of demolishing it, but then you decide to actually regenerate it and improve it. So what happens in that case? In the case of the improvement of an existing building or a part of a building, because some people you find that they don't actually improve the entire building, they could improve, say, first floor, second floor. So it does happen. Okay. In that incident, it does happen. But then what are your allowance in that regard? Okay. It says 20% of the cost of the taxpayer of the to the taxpayer of the improvement, extension, or addition which is deductible in the year of assessment, during which the part of the building so improved, extended, or added is brought into use by the taxpayer solely for the purposes of that person. So you get 20%. And 20% of that cost in each of the 4 succeeding years of assessment. So if you are involved in that space where you did an improvement for a part building, or for that matter, the entire building, therefore you'll get 20% for the next 5 years technically. So that is great. That is definitely great. It can alleviate, or rather it can actually ease the pressure. And from cash flow planning point of view, that's great. That's great. But it also helps the country in addressing issues of lack of housing. I mean, for example, if you're involved in a low-cost housing, it could actually help the country in terms of providing cheaper accommodation, and for that matter, especially in inner cities, then people are closer to a place of work and things like that. So that is very important. So you as a property investor, for that matter, you might want to leverage these type of tax incentives and make sure that you leverage and invest in demarcated urban development zones. But just make sure that you comply, because you're definitely not going to get incentives if you are not complying extensively with this. So you're more than welcome to reach out for further guidance, and we just bringing the awareness to you about this section. Now let's look at what subsection 3 capital A speaks to what, because as I mentioned about those who may actually be in a low-cost space. So it says, in the case of erection of any new building, okay, and to the extent that it relates to the low-cost residential unit, okay, is the amount of allowance is equal to 25% of the cost to the taxpayer of the erection. That's for those who are involved in the low cost sector, meaning that you'll get 25% as compared to the other person who may not be in a low cost residential unit will get 20%. So you get a little bit 5% more, but then you'll also get 13% in a subsequent year, you'll get 13% of that cost in each of the 5 succeeding years and 10% in the last year. So there's a bit of an increase as compared to as compared to the one who was not doing a low cost resident. And exactly, it makes sense. It makes sense because this speaks to very same purpose where the government is trying to make sure that accessible or cheaper, affordable accommodation is available to the people. And that's exactly that. This is another classical example where we always say the countries and tax authorities can sometimes government uses tax policies to address social objectives. And this is the social objective of this is to ensure that affordable accommodation is actually made available to the people. Therefore, in order to bring the private sector into that, assisting government to address the social objective, be it to provide affordable accommodation, they therefore make these incentives available to you as the property. So it's about that. So if the model is you're already in your business model, you're into, because I don't think you should go into this space just solely because you want to benefit from tax incentives. It should have already been your business model to actually be playing in that space of residential accommodation. And then even if you deviate a little bit to focus on urban development zone, but has always been your model to actually invest in a residential accommodation. So that could be one of the reasons. Okay. Then he says, in the case of improvement of any existing building or part of the building to the extent that it relates to a low-cost residential unit. So now this is another. So it's similar to the earlier part, but then here we're talking about improvement for low-cost residential units. So you will get 25% each year, so which means over 4 years. So instead of over 5 years, the earlier on the other section where it has nothing to do with the low cost housing. So in a case of low cost, if you do improvement for low cost residential unit, then you'll get 25% deduction for the next 4 years, which is brilliant. So meaning that those distressed properties in urban development zones, if you invest in them, you can actually take advantage of that. Okay, there are scenarios where you find that you buy from a developer. There are people who will buy a couple of units from developers instead of themselves going and taking on a risk and doing. What does then say if, let's say, you're taking you go and buy from the developer? That's section that speaks to that, to say what allowance will you be getting if you go and take and you purchase a particular building or a part of a building from a developer. So it says subsection 3 capital B says, for the purpose of subsection 3 or subsection 3 capital A, where the taxpayer purchased a building or a part of a building from a developer, 55% of the purchase price of that building or a part of the building extended out of any developer will apply. Okay, so which means that if you buy a building or a part of a building, only 50%, 55% of the purchase price will be applicable for the purpose of us using them. Basically, this section is giving us the amount that they will use to determine those deductions we spoke about, provided that you bought this building or part building from a developer. But if you do it yourself, then those sections will apply. But if you then buying it from a developer, then this section will apply to you. Okay, so I think that's pretty much it for those that are investing in urban development zones. You might want to actually bear in mind some of these tax incentives. I brought all these tax incentives that are available, that National Treasury together with relevant tax authorities, government, they're trying to make them available to stimulate a business, or for that matter to meet certain social objectives. We've seen it as social objective, be it to meet accommodation needs, or for that matter, to address the distressed buildings or distressed inner cities, or for that matter, certain social objective could be to stimulate job creation. That's when we're starting to see, or certain sectors, for example, manufacturing sector. What do you do to stimulate those sectors, or for that matter, to help and empower SMEs sector? That's why now you see these provisions be made, or these tax incentives be made available. If you need help, you're more than welcome to reach out to me on WhatsApp 074-589-6439, or for that matter, you can email us on shillyboy@taxedu.co.za, and we can engage, and we can talk about bringing awareness around some of these taxes, incentives, and certain provisions. Okay, cool. I think that's about it. Okay, so you will know that the recently, or in the 2025 annual budget speech, the Minister of Finance actually did not adjust personal income tax brackets. Yes, personal income tax brackets were not adjusted for inflation. I just want us to, because I've seen taxpayers obviously are not happy. So am I. I'm not happy. But let's try to see the implications of that, and let's try to have a chat about why also government opted for that, and then we take it from there. So the implications, or rather what could work against us as taxpayers, that everyone is actually talking about, is the fact that if, for example, in 2025-2026 year of assessment, I happens to get an increase, or for that matter, even bonuses, it means that I'll probably jump into higher tax brackets. Okay. Because those brackets were not adjusted for inflation, as sometimes it happens in the previous years. It means then I will then be subjected to a tax. Would you agree with me? That's a pretty much what we're saying. The reason why you're seeing that is because in South Africa, we've got what you call progressive tax system, or progressive tax. What does it mean? It means we start from low and going higher, meaning that from a certain range, you may be paying a particular tax that is lower as compared to someone that is earning a certain range that, say, for example, 1 million to 1.5, they may find themselves with falling in a higher tax brackets with higher tax rates that are applicable to them. That is typically what happens. And the thinking behind that is that an average tax that you'll probably pay will probably be lower than the marginal tax rate. What is the marginal tax rate? A marginal tax rate is the highest tax rate that is applicable to you in your certain portion of your income. Let me give you an example. Let me say I'm earning R1 million. It means that at the certain top brackets, you may find that between 800,000 and R1 million, I'm taxed, for example, at 40%. But then between 0 and 800,000, there's different tax brackets, the tax rates that are applicable in that category. Therefore, it means my marginal rate is what? It's 40%. So that is why. But then typically you'll find that your marginal tax rate is actually different to effectively what your effective tax rate is, because your effective tax rate, you can easily get it by saying what's your tax, ultimately tax liability, divided by your gross income, for that matter. That's how you typically can be able to see what your effective tax rate. And within that, obviously, it's going to be influenced or affected by certain deductions, say donations, Section 11, capital F, deductions. So that is how we our system operates in South Africa. And of course, as I explained, the marginal tax rate, the effective tax rate, that it will be different to that. So that is typical. So now people obviously are not happy to the fact that, so am I. We're not happy that the minister actually did not adjust the tax brackets. And therefore, we could find ourselves actually paying more tax. But why did the government say that? And I'm going to just, one of the key things that government actually opted for that is because the government is facing with fiscal pressures. Yeah, they are actually, one of those is they're spending on health, they're spending on teaching. It can put that on education side of things. They're spending on social relief grants. That's one of the things. I think also one of the things that to stimulate economic growth is around the spending on infrastructure. There's a campaign or a reform that is termed Operation Vulindlela, and spending on infrastructure is one of the things. So there's this spending that is putting pressure on government. That's why now government is trying by all means to find alternatives ways of actually finding money, or rather, so that they can move money into those pressures, or rather as those spendings that government is looking into spending in. Okay, now one of those is that obviously government is looking at various alternatives to ensure that it doesn't find itself being faced with these pressures in the near future, so that potentially we could find these our personal income tax brackets actually being adjusted for inflation. What is the government actually doing going forward to ensure that it doesn't find itself being faced with these fiscal pressures? One of the things that I want to bring to attention is actually exactly what about the broadening of the tax base. What does that mean? It's actually meaning that closing loopholes and closing loopholes within the tax administration. And we spoke in our previous episodes, we spoke about some of the initiatives that SARS is actually doing. I'm just going to remind you at the end of this segment. Exactly that SARS it's working extremely hard. We've seen budget allocation to capacitate SARS so that we're closing loopholes, and that is exactly what, so that the government can collect much more revenue, tax revenue, and then that can be redirected to some of these government spending, particularly on infrastructure spending, so that it stimulates economic growth, and then therefore there's job creations and there's more tax revenue to be collected. Of course, then broadening the tax base, exactly that, meaning when you broaden the tax base, bring more, some of the taxpayers that's supposed to be in the tax system, they may not be in the tax system, so we need to bring them into the tax system, because for whatever reasons they're not disclosing and they're not actually sharing what do you call it? They're not submitting tax returns as they were supposed to do. I think also one of the things that you probably will most likely going to start seeing, one way to broaden the tax base also will be to do away with certain tax exemptions, tax incentive schemes. We'll probably see that. One of them was those solar, there was once-off benefits that household got when you installed your solar panels and things like that. We've seen it has not been renewed, meaning that we have done away with it. So those are some of the initiatives that we may see in future, where in order to broaden the tax base, certain tax incentives that actually are not. One of them that we saw in the previous years that we did away with was Section 12J. We also saw that going away. That's another form of broadening the tax base, because the more you let go of those tax incentives, then it means that the system actually can actually collect more tax, because people now will not be deducting against their income those allowances. Okay, so that is one way of broadening it. And these are some of alternatives that government is looking into. Of course, some commentators are saying we need to perhaps cut on government spending on salaries and personal cost. That is one. But of course, also inefficiencies that may be there in the government spending, fruitless expenditures that are there. So that is one way of finding ways of broadening the tax base. But I want to also remind you some of the things that I know that SARS is actually doing in order to assist with easing the fiscal pressure. And exactly that, where we said the broadening it. SARS, as I mentioned in some of our previous episodes, is that they'll be focusing 2025, 2026. It's that they'll be focusing on reducing the balance sheet, meaning that they'll be collecting their debt. They're going to send those letters. They're going to send those SMEs, continue making those calls, continue communicating with the taxpayers on the outstanding debt that you need to pay. So that's another form of things that SARS is actually going to be doing to ensure that it assists with easing the fiscal pressure. Of course, those who are not submitting tax returns, if you're one of those having submitted tax returns, you'll probably be some of the people that will be chased and will be will be followed up on. Those are some of the things that the tax authorities are going to be focusing. I spoke of closing the loopholes, and exactly that. SARS is it actually call it the tax gap themes. They will make sure that the tax base is broadening, formal and informal. So they'll bring those that are not into the tax system, be it from formal and informal economy. They'll try to bring that. Of course, then also they will focus a lot on high net worth individuals. We spoke on that. So if you're one of those people that are highly high net worth individuals and you're not disclosing money, particularly those who are maybe having side hustles and you've got property properties and you're generating rental income, but you're not actually disclosing and submitting tax returns, you should be doing that. And if you're not, it's not going to be nice when SARS. So these are some of the things that SARS is going to be doing in order to assist with easing the pressure. Perhaps when this fiscal pressure is actually eased, and that could actually see us also our tax brackets being adjusted for inflation in the near future. Okay, I think that's about it also on this segment, and I will have a chat with you on other various tax initiatives, and will bring awareness to you as the taxpayer, and make sure you also do and ensure that you meet your obligation as required in terms of the tax legislation. If you need any form of help, you're more than welcome to WhatsApp us at 074-589-6439, or you can email us at shillyboy@taxedu.co.za. That's it. My name is Shillyboy Mothiba. I'm your host of the Tax Awareness Show. Good luck and thank you for watching.